Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, June 7th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead Trader Viper XL 007, and we are going to take a look at some of the latest news out there in the world of crypto and regulation. So what are we going to touch on? We're going to touch on a couple of facts here. We're going to touch on who the heck is the SEC. And along those lines, then we're going to say, what the heck is a security? And then lastly, we'll kind of raise the question, is this the end of crypto? But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You can also find a link down there to thetagang.com/sprocket888, where I post each and every one of my trades, the good, the bad, and the ugly. This is also available wherever you get your podcasts, so pick it up there. And if you can't find it, let us know and we will get it there. But let's hop to the topics this week, Viper. The topics of crypto and the SEC and what all this means, because this recent week there's been a couple of big shakeups in there. People could say that the shots were fired long ago, with the SEC filing suits against Coinbase as well as Binance, and even Binance's founder got some call out and some special suit action there. But before we kind of just jump to some of that commentary on that, I think it's pretty important to kind of touch on who the heck is the SEC. And so maybe we can just briefly cover a little bit about the SEC and who they are. And so the SEC, I just put together a couple things about it here. It is the Security and Exchange Committee. So the SEC really came about as a direct result of the stock market crash of 1929. So at the 1929 stock market crash, one of the greatest market plunges of all history, not only did the stock market plunge, but it just sucked the entire American economy and just the livelihood of millions of people across this country into just a giant economic depression known as the Great Depression. In the height of the Great Depression, I think there were upwards of over 1/3 of the U.S. Citizens were basically unemployed and out of work. And all of this kind of was a subsequent effect of the first dominoes to fall in the stock market crash. There was a run on banks. And as the country was kind of licking its wounds and piecing itself back together, there was kind of a problem of confidence where the American people, the world, didn't have a lot of faith in the markets and the things that you would buy and sell and trade, because they just had their entire livelihoods wiped out. And a large part of that was due to no regulation oversight whatsoever about the types of reporting that had to be done, the types of information that had to be shared and disclosed to all these people that were putting money in the market, money in investments. And so as a response to that, Congress put together the U.S. Securities Act as well as the the Securities and Exchange Act. And those two things kind of combined together in the mid-1930s, early 1930s, to form what's now known as the SEC. And they are an independent body of oversight. They're headed up by 5 commissioners that are appointed by a president, confirmed by the Senate. They have interesting stipulations that they wanted to maintain bipartisan. So actually no more than 3 members of the committee can ever be a member of the same particular political party. Additionally, each member is staggered. They serve for a term of 5 years, and every year one of them is up for election. So they're kind of staggered to get a rotation through there. So theoretically, no president can pick the entire SEC committee. And their goals are really to interpret and take the laws that Congress passes with respect to securities and exchanges and enforce them. So they are basically an enforcer of laws that are created by Congress. So this is very similar to, your branches of government, where you have the legislative branch making the laws, you have the executive branch enforcing the laws, and then you have the judicial branch kind of gauging the legitimacy of the laws against previous laws and the Constitution and things like that. The SEC is very much kind of like the executive branch, where their job is to enforce the rules that are out there. So that's a little bit about the SEC. Viper, I don't know if you have any other thoughts on who is this thing, an entity called the SEC?
No, not particularly. I think that sums it up well. Because I know, I'll probably mention it more as we go on here, but I did go back and listen to our January 4th episode where we first talked about crypto regulation. And it was what I took as most interesting going back, aside from what has come to fruition as far as what we expected to come to fruition, which is exactly where we are today. What was a fun reminder to me personally was listening to myself talk about SEC versus the CFTC, and just remembering how less knowledgeable or less educated I was back then, and the SEC seemed like much more of an obscure, like, who is this? Why do they? Is it bad? Is it good? Like, it's neither. It's just it is. It's a they have a jurisdiction. They have an umbrella. And they do a specific role and function as prescribed to them by the law. So yeah, nothing really to add other than just my anecdote of the spirit of what we're doing here, and that is learning and not experts in any of this.
So yeah, I mean, going back to that January 4th episode, I remember we talked a lot about the SEC and the CFTC and, where does each one play? And, the CFTC is the Commodity and Futures Trading Commission. And I know that we put a lot of comments in there about, oh, well, that's where Forex is traded, currencies are traded, things like that. And a lot of these coins are really just digital currencies. And so that makes sense that it would be under them. And in kind of researching some of the stuff that had been put out there most recently by the SEC as to why they were raising these cases against these entities, I learned about the Howey Test, which I didn't come across when I was kind of researching things back in January 4th, but it was all over everything now. And so you might say, well, what the heck is the Howey Test? And that is the next thing I want to talk about, because this is a ruling that I think Howie Mandel himself was involved in. Wait, no, it wasn't him. Happened way before him. But Howie Mandel is going to help us explain the Howey Test. This happened back in 1946. It was a Supreme Court ruling around a farmer down in Florida, or an investor in Florida. I'm not sure what side Howie was on. But basically what Howie was doing was Howie was selling land to investors or citizens, and they in turn would lease the land back to Howie. And then on this land, they would grow citrus trees, and they would share in some of the revenue of this. And in the Supreme Court ruling, they said this was indeed the definition of a security. And that's a little bit strange, because you might think a security is a particular paper instrument or representation of the stuff that you buy and sell in the market. But basically the outcome of that Supreme Court case was this Howey Test, where it says there's basically 4 criteria that define a security. And if you check yes in these 4 questions, then you indeed are a security. And those questions are: is there an investment of money? Is this investment into a common enterprise, or a common goal, or a common collection, or a pool of people that are getting together? Are you all in the same vested interest? And then continuing on, Is there in this investment and this common enterprise an expectation of profit? Not is there profit, is there an expectation of profit? And then lastly, is that expectation of profit or that return to that common enterprise based on the money that you put in initially, is that the result of a third party? And if you answer yes to all four of those things, then you have a security. In the Supreme Court case, there was an investment of money because those people purchasing or participating in Howey's project or program had given him money to buy the land. It was a common enterprise because they were all vested in this citrus growing operation. There was an expectation of profit that they all had. And that profit in return was the result of a third party, because part of their arrangement in that program was that the person that bought the land and leased it back didn't have to do anything. They were hands off. They hired, Howey and his group hired different workers to basically plant the trees, farm the citrus and all that stuff. And so in those four cases, they passed the Howey test.
Yeah, this was fairly new to me as well. I think back in that January episode, like it had just started. I mean, obviously it's been around for a while, but I think back then it just started to come up in regular discourse, and so I was just getting the gist of it back then. But now, yeah, as we're full steam ahead, I mean, this is coming up in just about every appearance that Chair Gary Gensler is in. I mean, it's coming up all over the place, and I mean, if it sounds simple, it's kind of on purpose. It's meant to. It's not a golden rule. So I mean, there are things, and there's some stuff that I'll show that particularly meets these four questions, but there are some important distinctions or stipulations. So that end up not making something a security, but it definitely starts with these four questions. And that's one thing that I'm certainly learning and catching on to, is the importance of this as a metric. You know, if any of these fail, then you know, okay, this isn't a security. If all four of these pass, you're like, I got to be careful, like what's happening with this, or you know, what dig deeper sort of situation, which is kind of where we're at today, I think.
Yep. And you know, the next thing we'll kind of tackle from here is this the end of crypto? And one distinction I kind of want to call out here, because I'm sure you'll get into some of this, Viper. That the Howey test, when it comes to these digital currencies and these tokens, going back to that January 4th episode, I don't remember how much of it actually made it into the recording, but I do know that you and I were talking about the parallels between some of these tokens and more of like a currency that's traded versus a security. And this is pre my knowledge of the Howey test. But if we look at, let's just take two things. I'll use Bitcoin, because that's always in there about what about Bitcoin? What about Bitcoin? If we go through this Howey test, we don't make it past step one. So question one is there an investment of money? And in a lot of these coins, they had what was known as an initial coin offering. I think we even talked about this similar thing back in January 4th. But the big distinction where the first question of the Howey test falls down is, did they offer an initial, hey, I've got this new coin coming up, do you want to buy into it? And if that happens, then you're passing the first question of the Howey test. But in the case of Bitcoin, there was no entity that sold the first Bitcoins out there that says, we have invented a Bitcoin and I am putting them out of there into the world through this coin offering. No, the only way that Bitcoin came into be was through these miners and this calculation. And when you found one, boom, you had one. I know this because I was some of the first people finding Bitcoin before I lost it all. But go back to that episode and hear that sad story about Mt. Gox. Whereas a lot of these newer tokens, like I'll bring up MATIC, because I think you might actually bring that section in from the latest ruling, which, yes, on the surface, you might look at it and say, oh, yeah, this is a utility token. It's just there to provide, utility to purchase things and participate in an ecosystem. But the creators of MATIC basically sold a bunch of them at the very beginning to get them out there into the world, and they have passed that first question of the Howey Test: is there an investment of money? Yes, people traded their fiat currency for a section of these in the initial kind of flooding of the market.
Yeah. And I'd even add, because like you said, Bitcoin comes up all the time, and Chair Gensler has adamantly said Bitcoin is not a security over and over and over again. And it's clear why, because I mean, it actually fails 3 of these 4 questions here. The only one it kind of passes is expectation of profit, but that's a given in a speculative environment. So there is no common enterprise. Like you said, it was launched as this, experiment in decentralization. There was never any organization at the helm of it. There was just code kind of released, and then people like you would pick up that code and run it on hardware, and all of a sudden you'd start contributing to this decentralized world. So therefore, the 4th question is, well, profit and return as a result of a third party. There is none. There is no third party. It was just you and your hardware. You put in the work to get the miner running, to run the code, all that kind of stuff. So Bitcoin is a pretty clear example across the board of what I would say correlates very well to the currency, like you just said, as to, it's a store of value as it was originally designed. Things get, initially we would say things got muddy as you get out of that and into smart contracts. But as I'm digging deeper into this and not taking the media or even Twitter takes at their face value, as I'm trying to go deeper and learn what's under the surface here, it's kind of not that muddy. it's I don't know. Maybe I'm missing something that's making it too clear, but that's kind of where I think we should go next.
Yeah. So talk to us. Is this the end of crypto? Should I sell it all and run for the hills until the dust settles of the lawsuit? I mean, what's going on out there?
Yeah. So before we get into any visuals or kind of step through, is it the end of crypto? I mean, you would think so, no matter where you get your news source from, whether you're getting it from TV, whether you're getting it from social media. You have your Jim Cramers going on saying it's the death of crypto and all this stuff. And then you have your maximalists on Twitter that are going, they're going to kill it. They're gunning for it, and they're going to try to suffocate it, and yada, yada. So, you would certainly think so. And as we often talk about, with news and stocks and prices and all that kind of stuff, news is noise, and noise is loud right now. So at a very high level, though, I hope I can capture everything I want to talk about, because there's a lot of it. Because anytime we talk about crypto and regulation on here, I have been waiting for this exact moment. This is where, in order to get to the other side, because I do have a belief in the underlying technology and the benefit that it can offer, we have to have what I would say is a mass reckoning moment, a mass culling moment, where just things are flushed out of the system that shouldn't be there or were opportunistically there. Just like any new market, just like any new, Wild West, you have legitimate stuff that's mixed in with, certainly illegitimate stuff, but then stuff that just wasn't properly done. Like, I don't want to say everybody has this malintent, but we need to get through this. And I think we're, and in that January 4th episode, there was another thing I said, which I don't know, still may be true, but it was January 4th. And I said, I don't think we're going to get through to the other side anytime this year. And then we kind of laughed about, well, there's, 361 days for that to be proven wrong. And it's still true. I don't think we'll get through it, but I think we will get certainly an understanding of how current financial laws apply, and any changes that need to happen to that will have to go through congressional, the lawmaker body itself. And that's where things are going to take a lot longer. But I'm very optimistic that what's happening now, we're going to push a lot of clear guardrails for if you're operating in the U.S. or want to operate in the U.S., here's precedence. And I think we're getting a lot of precedents set right now. All right, let's see if we can do this. First, so there are two major lawsuits that are happening right now that you've probably heard about. Binance and Coinbase are the two that the SEC is gunning after. They're going after both of them in very different ways, though there is a slight overlap. So I'm probably going to spend most of my time on the Coinbase one, but I definitely want to hit the Binance one first here. So I've pulled up the filing document by the SEC, and it's a big, long document. Like I said, my goal is, first of all, not an expert, not a financial law expert at all. This is just learning in real time like we like to do. But reading through these documents has been much more interesting than I ever expected reading through a 80-page or 100-page filing ever would be. So in the case of Binance, there was a couple things that were most interesting. First of all, there's the one thing that they're going hard at Binance for is kind of just outright fraudulent behavior and deception of U.S. investors. Things that mirror a lot of what FTX was doing. So they're blaming Binance for things like counter trading their investors, conflict of interest, commingling investor funds with other investment funds, all that kind of stuff. None of these things they're not making any of these allegations against Coinbase. They're making those directly to Binance, that is something that everybody's. We talk about how we don't trust centralized exchanges. Usually, we talk about it from the perspective of their role in a decentralized system and how it's not needed and it's unnecessary. But there is a lot of distrust in the space just for exactly these reasons that the SEC is going after Binance, the counter trading your investors. I mean, there was on the rounds of talk shows that Chair Gensler was on, he was talking about, imagine that the New York Stock Exchange had a hedge fund that was counter trading all of the investors, all of the moves that they were seeing. Like, that's a massive red flag and, illegal behavior. So that's a big thing that they're going after Binance for. That's why Binance has a much larger footprint of its enforcement action, I think. But one of the things that I found most interesting in the Binance filing was this section here, talking about crypto assets traded on the Binance platform and Binance.us platform included assets that were offered and sold as securities. And for the first time that I can think of, we are getting a list of trading symbols that the SEC considers securities. So we can see Solana, Cardano, MATIC, Filecoin, Atom, Sand, Algo, AXS. So this is, as far as I'm aware, this is the first time we're seeing an actual list from the top. All these coins are, I believe, still top 20 in the market. So this was the first time we're kind of getting a sense of which tokens the SEC is most focused on just as tokens themselves. So obviously the relation to Binance is the fact that Binance offers trading of these tokens. So now it's not Binance specifically. It's just saying, hey, these tokens are securities. You're offering the ability for people to trade them, and you didn't register as a proper securities exchange. Therefore, you're in violation of not having registered. You're an unregistered exchange. That is emphasized by this now infamous quote that is included in here, where it says, as Binance's CCO bluntly admitted to another Binance compliance officer in December 2018, we are operating as an effing unlicensed securities exchange in the USA, bro. So that's exactly what the SEC is claiming that they are doing, is operating as an unlicensed securities exchange in the USA, bro.
Whoops.
So now, yeah, whoopsie. Obviously you can see even right here on this page, there's, some of the, so CZ, is the CEO of Binance, developed a plan to evade U.S. legal scrutiny while continuing to profit from U.S. investors. So this is where it's not related to what they're charging against Coinbase. This is more the fraud and evasion side of things that they're claiming Binance on. The document has all kinds of receipts, if you will, of how Binance would construct a plan to say, we want the U.S. investors, but we don't want the hassle of dealing with U.S. regulators. And so there's all sorts of receipts and conversations listed in here about how they tried to manipulate that tightrope to get the liquidity from U.S. customers by essentially, defrauding them and, getting them to think that they were on doing the right thing, all while skirting U.S. Scrutiny. But this whole unlicensed securities exchange is where we kind of overlap now with what's being charged against Coinbase. So what's being charged against Coinbase now is primarily this point that Coinbase, you're selling what we believe are classified as unregistered securities. Therefore, you are operating an unlicensed securities exchange. And this goes into a whole thing where Coinbase is trying to adamantly defend itself, saying, well, the rules aren't clear, and we've tried many times to register with you, and we've gotten the pushback, and we've gotten ignored and brushed off, all that kind of stuff. And initially, I thought they made a convincing argument on all points. The more I'm, digging into this and understanding what a token looks like that is a security, the more I think Coinbase might have an argument on the side of things that says, we've come to you multiple times and tried to register and you haven't done it, or you haven't helped us do that. That's something that, the court, that just needs to go to the courts, not the court of public opinion. Take your documentation, take whatever you can, and get that settled there. The whole argument of the rules aren't clear or whatnot. I think the rules are getting pretty clear, as we'll go into next. So I don't buy that as much. And so it's kind of walking this line of the marketing side of it, of don't waste a good crisis, as they say. All press is good press, while also trying to actually make any sort of legitimate case. And I feel like that's kind of where Coinbase is at in the.
Yeah, I remember, I don't remember if I talked about it before, but the whole premise of you didn't know, ignorance is not actually a good defense in any case. Like, oh, well, it just wasn't really clear to me, I didn't know. Usually won't get you very far.
As we are about to find out, or we'll see. I mean, well, I guess we will have to find out because it's in court now. It's been filed. And the last argument Coinbase has made, which I think is an interesting wrinkle, is about a month ago, before the SEC filed this lawsuit. Coinbase actually lobbied to the SEC as a petition from the last enforcement action when the SEC served that Wells notice that I think we talked about on a previous episode to Coinbase. Coinbase responded to the Wells notice and said, we would like clarification on XYZ. They have yet to receive that clarification, which the SEC is legally obligated to give them. So that's an interesting little wrinkle in this lawsuit, that there was a circuit court that just within the last couple of days ruled that this main Coinbase lawsuit is paused because the SEC needs to respond to that request that Coinbase made. Feels like a ticky-tacky thing, but at the same time, it'll be interesting to see how they do respond to that. So if we jump over to the Coinbase lawsuit now, over here, now this is where I was very interested. So we have this listing now of these tokens that the SEC considers securities. So now we're getting into where I'm really interested to see how this plays out, because I fully accept that there are tokens that I've either traded or I've done stuff with, I've invested in, that might become securities or become clearly securities. And so I'm stepping aside from all the exchange stuff. Like, I want to understand what is the SEC thinking on what makes a token a security and show me an example, walk me through it so I can help understand what they're thinking. Then I can predictively or preemptively make sure that I'm doing things as properly as possible in regards to that. So the one nice thing, you wouldn't know it again if you were following, most just any news source. Like I said, no matter if you're on the crypto maximalist side or just cable news side, everybody's still responding of like, we don't know what's happening. And I'm like, it's in the documentation. Like every single token that the SEC has called out, there's an entire section where they break down exactly what has happened that has led to them considering that token a security. So in this particular case, MATIC is a token that I have a mixed relationship with as far as my personal thoughts on the future of it and whatnot. It has never been a primary thesis of mine, but it's been interesting to see how it's unfolded. So I dug into that one first. And so the main takeaway here is as you read through this, like I said, the lawsuit is very complete, and the SEC does a very good job of, like I said, bringing their receipts and their thought process here. And as we go through this, you kind of see what we were talking about. So Polygon issued a fixed supply of 10 billion MATIC tokens, and it kind of talks about the underlying tokenomics of the token. So it sets the stage of how the token works. And then we get into in and around 2018, Polygon sold approximately 4% of the total supply, raising $165,000 at this US dollar price per one MATIC. And then it goes on to talk about, so here's that Howey test. Here's the initial, there was an investment of money. There was a common enterprise, which was the Polygon Foundation. And, it kind of walks us through that. And so here's now the expectation of profit. For example, Polygon stated publicly, including in the white paper, that it would pool investment proceeds through its private and public fundraising to develop and grow its new business. Okay, so this was actually not the expectation of profits, but this is what did you use that money for? Did you use that money to invest into that common enterprise, which is going to help grow that common enterprise and thus produce those profits to the people that fundraised and helped grow that common enterprise. And then we kind of, as we keep going through here, it gets into the expectation of profits, even bringing in a tweet from Sandeep Nawal, who is the founder of the Polygon Foundation. He tweets here, I never talk about token price, but if MATIC token had a spirit breaking all-time high 14 months after the ominous crash of 70% in a day, it would echo words from this apparent famous boxer champion, and, implicating profits should be coming and stating, I will not rest until Polygon gets its well-deserved top 3 spot along Bitcoin and Ethereum. No other projects come even close. And so, there's a lot of details here about this expectation of profits. So this, by all accounts, passes the Howey test of investment of money. There was a pre-sale. There is a common enterprise, the Polygon Foundation. There is an expectation of profit saying, hey, we're going to work hard. We're using those fundraised funds to upgrade the system, and that is going to produce a top 3 spot right next to Bitcoin and Ethereum, which is going to yield massive profits to those early investors. And again, most critically, that fourth one, profit and return, is a result of the effort of a third party. So it's the effort that the Polygon Foundation is putting into this that's going to produce those profits to those initial investors.
And just like my good buddy Howey says, if you got all that, you've got a security.
You've got a security. So there's another interesting claim in this document that I thought was worth pointing out. So if we hop back over now, there's a section later on in the Coinbase filing that a lot of people were using to claim like, Ethereum is a security, which so far the SEC has gone on record to say Ethereum is not a security. But there is this section way down on page 81 where it gets into and names Ethereum. So, people are taking what I think is a little bit out of context, where it says Coinbase has violated the Securities Act by engaging in the unregistered offer and sale of securities in connection. So they take the engage in unregistered offer and sale of securities, and then they kind of jump ahead to where it names Tezos, Atom, Ethereum, Cardano, and Solana. And they say, look, there's Ethereum. But what I think is interesting in this particular case is if we keep reading, it clearly says with its staking program. And so this section here breaks down, if anybody's used Coinbase, you're familiar, if you hold Ethereum as well as those other tokens listed, if you hold any of those tokens, you get an interest rate. And we've talked about this before, as far as the collapse of Luna and all this stuff, but you get an interest rate and it's how you get that interest rate, which is important. First of all, in the collapse of Luna, nobody knew where it was coming from. They were just saying, you get 20% interest for staking with us. So that's step number one as a good investor, is know where your interest rate is coming from. But in this particular case, it goes one step further. So when the whole Luna thing happened and BlockFi and all these other things were getting in trouble for having these staking programs and offering an interest rate and not explaining where that was coming from, the thought literally went through my head. I was like, oh, well, Coinbase, it makes sense. And I did the math, especially on Cosmos. Or no, not Cosmos. It's actually not listed here, but Algo. Algorand is an interesting cryptocurrency where just for holding the token in your wallet, like no like depositing it into an application or anything, just holding it in your wallet, you get paid an interest rate from the way the tokenomics work in the thing. So it's real. It's a real interest rate. But I thought about that because Algo was something Coinbase offered for a while. And so I did the math on it. And I was like, no, the math checks out. Like, they're not making up the number. Like, this number checks out with exactly what you would earn if I was holding Algo in my own non-custodial wallet. But what I thought was interesting here is in the case of Ethereum, they explain that to participate in the staking program, you need only have or open an account at Coinbase.com and purchase staking eligible crypto assets on the platform, or transfer existing eligible assets to your Coinbase account. So they're laying out the process of how you partake in this staking program, which is where Coinbase pools all this Ethereum together. And we're just going to talk about Ethereum. They pool all the Ethereum together, and then they go stake it into a massive validator node, which then generates a reward. And then they pay that reward to the investors, taking it's listed in here somewhere. They take a cut off the top for themselves, and they pay the rest of it out to you. And what's interesting, I thought, was the thing about that process that makes this a security is that fourth budget, or that fourth item on the Howey Test. It is profit reliant upon the efforts of a third party. And this section, oh, there it is right there, 25 to 35% commission. This process relies on Coinbase to do all the work to set up the validator node, to stake and lock your assets into the validator node, because you can't just free willy take your ETH in and out of a validator node. There's a lock period when you go into staking. So this section, I thought, did a great job breaking down the fact that the staking through Coinbase's offering is not the same experience that somebody would have to go through in the non-custodial world, where you would actually have to bring your investment, bring your money, put your effort into setting up a validator node, do the effort to do this thing. And so the path to those rewards is very different and reliant upon Coinbase in their offering versus if you were to go do it non-custodially yourself. So I thought that was interesting and illuminating to me to see that distinction, because again, the common thread has been the effort reliant upon somebody else, but there's also this interesting undertone thread that's weaved throughout all of this where they're actually using the concept of self-custodianship as the example. So they're saying, you know, if you were self-custodying this is what the process would be. That doesn't, that's not equatable to what's happening in the when somebody else is custodian over your funds. And so I think, to me, that's interesting to have that parallel between non-custodian and custodian over your funds. And that's also something that, you know, has obviously been a topic we've talked about as far as why we generally don't use these centralized exchanges, because the whole point, at least to Sprocket and I and a lot of people in this space, is having that self-custody over your assets. And it does seem pretty clear in all these filings that the SEC values that as a key thing as well.
Viper, the one thing I kind of want to add, because I've heard it in the media and different articles and different Twitter posts and stuff like that, where people are like, but Coinbase, what are you doing, SEC? You knew what Coinbase was when they registered and they did an initial public offering. Why are you bringing this up now? I mean, Coinbase IPO'd forever ago. What gives? You know, what are you targeting? And I think that, okay, I get where they're kind of coming from, but I think you have to judge a little bit about what is the point in different phases and in activities that a company is engaged in. An initial public offering, the SEC doesn't have an obligation. There's no rule or anything in there that says, hey, you got to make sure that you're only doing legit legal stuff as your business and this, that, and the other. That IPO process is about your financial books. How do you run your company? How do you manage your company? It's not about the products that you sell or the activities you participate in. I mean, you can look back at many, many companies that were legitimate public companies where something happened later that was a way they conducted business, things that they did. I mean, take Enron, for example, right? Enron was a legitimate public company. Now, they engaged in very fraudulent activity of cooking the books and messing that stuff up later, but the role of the SEC when a company is going public is not to validate and vet, is this a legitimate product offering that they have, and what's this thing? It's all about, hey, what are the disclosures of their financial books, their financial records, their activities with respect to, are they reporting things according to the reports that they're supposed to be out there and stuff like that? And I think that sometimes gets a little bit lost depending on what type of media message wants to get spun.
Yeah, exactly. And that was actually a point that I meant to bring up earlier. Was that's like the third major argument that Coinbase is making in their claims of victimhood here is, hey, but we came to you already and yada yada, like you said. And I agree. Like initially I was like, yeah, that's true. Like, and I kind of bought into it a little bit. But again, the more I think about it, the more I read into this and stuff, like, yeah, like you said, that's not the purpose of an IPO clearing and getting approved for listing is not, like you said, it's not about the product. It's, are you legitimately running your company? Do you have the funds you say you have? Are you launching your stock shares, in a way that's compliant with how we operate the stock exchange? So that definitely falls on that's not something I give them credit for or leniency on because it just doesn't hold up. So we could come to the end of this and think, well, what the heck? Like crypto is dead. Like everything is, tied up in this, like you did an initial offering, you did a pre-sale, so everything's just, it's the ticking time bomb before everything's screwed. But I've found a few examples of how do you do this and do it correctly. And the only definition of correctly here is compliant to U.S. regulatory bodies. Obviously, there are regulatory bodies all around the world who see things very differently. And that comes up all the time of like, oh, you still want to live in the U.S.? Like, move over here. We do things like, but correctly in regards to U.S. regulatory bodies, there's two primary examples that I've seen. One of them, try not to name drop or anything because I do have bias towards these or whatnot. But one of them is a blockchain that when they decided to launch, first of all, they did zero pre-sale. They did none of that. They did do a pre-mine where as a company, they pre-mined, I think it was either 49 or 51% of the total supply of the token. So they didn't buy it. There was no investment of money, but before they launched the blockchain to the public, they pre-mined a significant share of the tokens strategically. So that way those shares, those tokens were tied to the company. And then they just recently filed an IPO with the SEC to offer stock sales in the company, all, regulatorily compliant. And the thinking is that the value of the company is tied to that pre-mine, which there was no investment of money. But then if somebody in the stock market wants to invest in that token, they can buy shares of stock, all above board, all approved and, regulatorily compliant. So that's one way. They like to think that's the only way. But I don't think that's quite true. There's another example that I found here. If we look into this Rule 506B from the SEC. And so this is basically Rule 506B of Regulation D is considered a safe harbor under Section 4A2. And basically what this is saying is you could do, and this is another asset that is notable that it's been absent on the list because, like I said, that list previously, so far, like 12 of the top 20 tokens on the market have been called out by the SEC. Some of those are just stable coins, but there is one that's not listed, has not been called out, and I feel like it's possibly related to this, where the central entity that was responsible for launching that token did do a pre-sale. They did do all those initial offerings. However, they went ahead and they filed this Regulation D form of Rule 506B for a safe harbor, which basically says you can launch your token as long as you do it, or you can file this exemption to, acknowledge that you launched a security, but you did not need to register as a security because you met this certain criteria. And so basically, this breaks down what that criteria is, like no general solicitation or advertising to market the securities. So they couldn't take out an ad on TV of hey, come be a part of our pre-sale. And securities may not be sold to more than 35 non-accredited investors. And so in this particular case, as far as I understand it, a non-accredited investor would be somebody that is under the U.S. jurisdiction. And, in this particular case, I read this as this is allowing for the company to be U.S. based, but allowing them essentially 35 waivers of people that can participate as U.S. residents. However, nobody else that participates is allowed to be under U.S. regulations. And this kind of continues to break down some of that. So that seems to be another legitimate way to go ahead and do the fundraise and launch a token as long as you qualify and apply. There's other rules that say you have to apply, notify the SEC that you did what you did at least within 15 days after you did it, and that you meet the requirements. You can also preemptively do it as well. So that seems to be a pretty clear way that you could still do that. And in this particular case, in what the examples I've seen of people that have done this, it's this interesting, yes, you are a security, but then you kind of push through. First of all, you got the exemption, so you didn't have to register as a security. And then it gets to a point where that common enterprise is no longer dependent, or the asset is no longer dependent on that common enterprise. So in the case of launching a token, the common enterprise, the asset is dependent upon the common enterprise, because if the common enterprise didn't exist, the token wouldn't exist. But then after it pushes through and we get into this decentralization of it, in some cases, that common enterprise is no longer common, meaning if that enterprise was completely knocked off the map and closed down and shut, whatever, the asset would still exist. It would still function because of the decentralization of it. That's not the case in all of them, but that is the case in some of them, which I feel like in what I've read so far seems to matter. And the last thing I wanted to go over was just there are examples and rulings like this one from November 17th, 2020, where we can learn about actual declarations of something that is not a security in the crypto world. And so in this particular case, we have this thing called Vcoin, which this is a ruling made by the SEC, which clearly states that with this is transferable and it can exist without registration under Section 5 of the Securities Act and does not register as a security. And then they kind of break down why they came to that conclusion. To me, and my vision of the future as we continue to unravel this thread, I feel like this statement stood out to me a lot. Vcoin will be immediately usable for its intended purpose at the time that it is sold. And so this goes to what I feel like is a very important nuanced distinction in all of these cases. Like I said, the common thread is how did you launch it? Who did you launch it to? What did you do with those funds that you launched, that you raised with that launch? And that's where all of these filings from the SEC are focusing on, is that launch process. Because, like Sprocket mentioned with MATIC, it's now today primarily a utility token, where you buy it today, there's no expectation of profits, and it's immediately usable for its intended purpose. So I think that's an interesting, we'll see how it plays out as far as the focus of the enforcement actions is on you did a thing to launch this token and you did it wrong, and there's enforcement on that action, versus a token that either, was never launched with that pre-sale, and when you buy it today, you can immediately use it for its intended purpose. And clearly we have some examples where that matters, and that actually gets a ruling that this is not a security. And therefore the SEC is saying, the FTC, take at it.
Yeah. So kind of tagging along a little bit to that, I really think that's kind of where the future of this is really kind of heading. I almost feel that these actions that the SEC are kind of taking are really to poke and prod Congress to be like, hey, there's a bunch of people in America clamoring for do something, do this, do that. You really have just kind of sat on your hands. Remember, SEC is an enforcer of the laws made by Congress. And I really think the SEC is kind of taking action to say, well, I guess we'll go by what we have in the books and we'll enforce them as we know it, and we'll march forward. And if you don't like it, then you're free to make new laws and redirect us. And is it the end of crypto? Where I would tie that in is I would say most definitely not. Is it the end of the way some of these exchanges are doing business? Yeah, probably there's a lot that's going to change there. Does it matter if a particular token is classified as a security or not? I don't think as much, because I think that has more impact on those centralized exchanges, because the SEC, what are they going to do? Go after these entities that launch the tokens? I mean, maybe, but they have to be under U.S. jurisdiction. So the best that I think they're going to do from that is get this to be classified as a security, and then go after those exchanges that are buying and selling those tokens that are classified as securities. And if you really look at the whole history of the SEC, and the different enforcements and stuff that they've gone after, largely what it is a slap on the wrist and a fine that you pay, you get into compliance, and you move on. And I think that's really where a lot of this stuff is kind of heading, which is the corralling and the pain that I guess Viper and I talked about a while ago. Is we got to get through this, and there has to be reputation and stuff made aware of everybody, that they have confidence that, oh, okay, this is clear how they do it, and now people have done this to gain that more industry backing and things like that. And so I think this is just the start of somebody has fired shots to say, fine, we'll play by the rules that are in the book today. Here they are, and then we'll just see what shakes out. And that's kind of where I think the spirit of what's happening is my perception of what's going on. I don't really believe that there's a targeted, oh my gosh, Gary Gensler's trying to drown crypto, crush crypto. No, I think he's just like, hey, my job is to enforce the laws that are out there. Everybody's screaming about enforcement or lack of oversight. Fine, I'll do it as it's written. You don't like it, change it.
Yeah. And I tend to largely agree with all of that. And Gary Gensler has said on a number of occasions, as far as whenever he's claiming to be doing these actions in protection of investors and things like that. One example that's come up is in this pre-sale and in this initial offering is where, it was something that clicked recently of like, well, how are you protecting the investors in this scenario? And one of the things of it is, there's a huge risk when a token goes public or a stock. I mean, we see this in penny stocks and stuff. If things are unregistered, when it goes public and there's already a huge chunk of pre-sale investors at a ridiculously reduced discounted price, that when this thing hits the public, those people who got the pre-sale are massively in the profits, and so then they take their profits and they end up dumping the thing on the investors that just got in on the public sale. And so in his mind, that's one of the scenarios that he's protecting investors from. But as we go forward, I completely agree that this is mostly an impact on the exchanges, and making sure that we get registered exchanges and exchanges that play by the rules and only list certain tokens and whatnot. And then as we go forward, like we saw, there's tokens that clearly have a precedence now of what does it take to behave and launch your token and make your token useful in a way that does not constitute a security. Some level of utility, no pre-sale, all that kind of stuff. For me personally, and how I'm navigating the space, is as soon as something shows up on the SEC's radar as an unregistered security, because my thesis, as I've talked about here, is trying to position myself where the mass adoption, pure speculation, but trying to position myself where the tech, because as somebody who cares about the underlying tech and making sure that's important, and also where the mass adoption is going to happen and positioning myself to be there. I very much believe that as long as there's a token that's listed as an unregistered security, pure speculation on my part, I do not believe that token is going to have any legitimate, institutional adoption, because to do that, those institutions, under U.S. regulations, would be buying an unregistered security, and then they'd be right in the same boat next to Coinbase and any exchanges that are not properly registered to deal with those things. And so I think that's going to be interesting to navigate. Is let's just keep using MATIC as the example. How does MATIC become quote unquote legitimate? It's labeled as an unregistered security. How does it become registered? I mean, is it the Polygon Foundation paying a fine for launching this thing unregistered to U.S. citizens, to U.S. investors, pay that fine, and then they're classified as security, and then maybe so that's part of what I think will be interesting as we go forward. But for me personally, I don't want to touch it until we get through that clarity. As soon as something is labeled, that's I think we're going to see a lot of winnowing of the field for anything that's labeled an unregistered security. It's probably just going to fade off the map as institutional money starts using the blockchain for its technology, for what it can offer, as a financial or just technological platform. So I think it'll be interesting, to say the least. But I guess that's kind of how I'm looking and preparing for it.
Yep, that's a fair assessment and a legitimate plan to move forward on it, or to what you're waiting for. And I don't really disagree with you on that approach. I think it's a good approach to have. And like we said before, once the stuff is cleared and understood and there's confidence in it, big money and big industry will most definitely step in to take advantage and leverage it, and probably take it to the next level. And who knows what we'll see come out of that innovation and adoption and stuff like that. I mean, like I said, I think we've equated this to similar to things before, like the internet and stuff like that, with any disruptive technology. So I'm excited to see where it goes. Yeah. And this most definitely is growing pains that they have to go through.
And I think the one thing that I forgot to mention as far as what keeps me interested, because on the surface, everything we just went through looks like, gosh, man, that's a lot of uncertainty. That's a lot of pain. Like, what the heck is on the other side of this? And so that was one thing that I forgot to mention as far as what keeps me speculatively involved and anxious to get through this is there is plenty of interest out there, publicly known, publicly talked about from major U.S. institutions. And so what I would suggest is just one off the top of my head. If you look up Wisdom Tree Prime, I believe is what they're calling the program. Wisdom Tree is a name everybody should probably recognize as a massive U.S. institution, financial institution. They have an entire, there's a whole website if you just search Wisdom Tree Prime, and it's a pure digital assets blockchain play that they are building and they want to get into. And so they're not alone. There are a whole bunch of other institutions that are lining up. They're already making their plans. They're already, building out their platforms. And so I feel like that's an important note, that seeing those things develop is what makes me so anxious to get through this and get to those deliveries and that reality where there is that clarity. And all of a sudden we have all of these financial protocols and things using this elevated financial technology.
Well, that brings us to the end of this week's episode. I really hope you kind of enjoyed the dialogue that we had here. This certainly is kind of uncharted territories, uncharted waters. I just want to reemphasize the go educate yourself, go look up the case files yourself. We're going to put a link in the description of the video below, specifically to the filings, the court documents that the SEC has filed against Coinbase and Binance. There's a lot of valuable information in there. Follow the Google Trail from there to learn about things. That's where we kind of found the Howey Test and looking into all this stuff. It really can be enlightening when you take ownership of educating yourself versus, I saw this on Twitter or I saw this thing on the news and oh my gosh, you get a different perspective. You're always going to get somebody's spin on something. So go to the source material, go read it yourself, come to your own conclusions. There's a lot there. I am most certainly sure that we're going to also be referencing this episode on June 7th at some point in the future that say, hey, remember when we were talking about that on June 7th? Oh man, what were we thinking? Or maybe we'll be like, wow, we said this thing then. That's amazing. So we'll also link to our video back at the beginning of this year on a similar topic and our perspective there. And we'll just keep bringing you this information as it interests us. It's in our space. It definitely impacts the stuff that we do. So, we're going to talk about it. So good luck out there this week. I hope you guys have a lot of fun trading, whatever you're dabbling in. Maybe it's in unregistered securities. Good luck to you there. But always remember, think outside the block.